introduction. Can you hear me? Yes. And I share the screen, yeah?
Loud and clear, and we can see the PPT as well.
Perfect. Okay. Great. So thanks again for the invite. It's always a pleasure to be invited. I think it's many years now that I present.
Dirk, can you put your PPT on slideshow, please?
Yeah. It's okay?
Yep. That's good.
Perfect. Okay. Yeah. Once again, thank you for the invite. I really appreciate it to be part of this great conference. And there's a lot of interesting information I can see in the program. So today I want to quickly have 20 minutes to talk about how to use gold in asset allocation. Seems like a question that has been answered already many times, but I want to show you that there's a component that highlights that it hasn't. So as you know, there's a large safe haven literature, but there's no study that shows how to use safe haven assets. So that is when to buy them and when to sell them. Most studies implicitly assume perfect timing and abstract from transaction costs. And so we do this a little bit differently, and also highlight that there's no systematic analysis of safe haven assets as strategic or tactical assets. So what is that? A strategic asset or allocation is defined as constant passive buy and hold, and tactical allocation is defined as a non-constant active investing. So essentially, it's always good to have an image or graph. So here, passive investing, you hold, you don't do anything. Active investing, what we analyze is essentially you don't hold it at all times. You go in when it's necessary, you go out when it's kind of necessary to get the higher returns from other assets. So the contribution, gold is known to be a hedge and a safe haven. Everyone knows that at this conference. The hedge is uncorrelated with stock market on average, and the safe haven is again uncorrelated, but with the focus on crisis times. And the question now is, what do these properties mean for investors? Should they hold gold at all times or only buy in crisis times? Interestingly, we are not aware of any study that has done that explicitly. I mean, there's a lot of studies that show that is gold or bonds, are they safe havens, but not when to buy it, when to sell it. Okay, so essentially, in a nutshell, or short, how to use gold, right? On average, yes, or also in crisis. So hold gold at all times, that's the methodology we will use, and we look at rebalancing, no rebalancing, and we then also specifically for the active allocation look at, okay, you buy gold in falling markets, or there's a shock and then you buy it. And then these two important components here, you buy it with perfect foresight, so you know you're either very fast, so you can immediately react to something ahead of the crowd, or you have imperfect crisis foresight and you always have a lag in your reaction, right, which is the more natural one. So we will focus on the imperfect crisis foresight because no one can perfectly foresee the future. And so the first one is more theoretical analysis to see, okay, how does it work in theory, which is often what has been analyzed in the literature or in general. And then imperfect is, well, you react with a lag. Yeah. So how does gold allocation affect the performance of portfolios? That's of course what we look at, right? Your final wealth, how does that change if you are active? So you go in and out compared to that situation where you hold at all times, buy and hold. And so this tactical allocation, we look at, there's a lot of variations. We look at full reallocation, partial reallocation, the imperfect foresight again, and then different frequencies, different weights, all kinds of different things, to get a very robust and clear picture. So the sample period is from 1971 to 2022, so 50 years essentially. And then as a one robustness test, we also shortened that to from 2000, right? Because people could argue, well, the last 20 years are potentially more representative of the gold market than the last 50 years. And the results are indeed very, very different when we use that shorter period. Good, in the outline slide, we look at different frequencies, but the frequency is not just like a statistical gimmick. So when we look at monthly data, that is implicitly also that you rebalance potentially on a monthly basis, right? So that means like there's a shock, and if you don't have perfect foresight, then you would rebalance the next month, where you're clearly too late. You miss that that shock month. On a weekly data basis, of course, you rebalance more frequently potentially, and daily data you can react much faster than with the other two, right? So these are three natural ways to look at the frequency of rebalancing and how fast you react to shocks. Good, so let's start with the monthly data and the potential rebalancing on a monthly basis. So first, the strategic allocation. So here we look at these are the percentages you put in a stock portfolio. We use the S&P 500. And so then here, when you put 0 in, 1%, 2, 3, 4, and the optimal, kind of here, the ideal allocation, strategic buy and hold is 4%, all right? Because that gives you the highest Sharpe ratio and the best mean standard deviation relationship. 4%, right? And that's now our benchmark. Because we look at you have everything in stocks, S&P 500, everything in gold, or everything in this portfolio where you have 4% in gold and then 96% in stocks. So, and this one, like I just want to show you this so this one is essentially tells you like we look at different thresholds on the left-hand side. So that is like if the stock market falls by 1%, and you anticipate that, so if you know that this will happen, and you always went out when the stock market falls just a bit, and then went into gold 100%, you did the full rebalancing, right, or reallocation, then the return would be extremely high. And it was so high that I thought, okay, this must be wrong. When you start with 100, and then you end up after 50 years with 49 million, that must be wrong, right? But it's not, because that's the perfect foresight. Right? And you can immediately react to any kind of shock. So essentially, then you hold something that is never that never falls. Right? You just get the positive returns. So a little bit more maybe closer to reality is that you don't go out of stocks 100%. So you sell all your stocks and you go 100% into gold, but instead you keep 95% of your stocks. You still suffer losses, and you go then 5% into gold. If you do that, you clearly outperform the strategic portfolio. That buy and hold is the column on the right. So the graph here shows you that for all these thresholds, you clearly do better if you do that, right? With perfect foresight. So the perfect foresight is that theoretical case that you always know what's going to happen. Theoretical, just to get to see whether this works in theory again. So if we now have imperfect foresight, so there's a shock, and we don't know that in advance. So we always react with a lag, and with monthly data, then like we react next month, then we have reallocated. If we do that, then the outperformance is like smaller. You can see that there's still outperformance for the lower thresholds, but it's not so strong, right? But it works better, and even though you have a delayed reaction and you don't have the perfect foresight. If you go into gold with 5%, you sell 5% of your stocks and you buy 5% of gold, in reaction to a shock, you're better off. It's quite surprising, because I would have thought, my hypothesis would have been that, yeah, if you're like on a monthly basis, when you're too late, that doesn't work, but it does. Right? So, but the trouble in general is that you think you have time, and sometimes you don't have time, okay? And that will matter for the shorter sample period. So now, if we do, again, imperfect foresight, so we don't know the future, so we react with a lag, and we do the reallocation, and we hold it for an additional month, right? We do not just hold it for 1 month and then sell, but we hold it for an additional month, then the outperformance is much stronger, right? So that means there is a shock. If you hold it like not just for 1 month, but for 2 months, it's better. And then there's, in general, there's effect, like if you hold it longer, it is better. But of course, then it kind of goes down at some stage. right? So now more frequent rebalancing. Again, the tactical allocation, now I forget I don't do the 100% perfect foresight. For the 5%, strong outperformance, very strong because you have perfect foresight and it's a strong assumption. So the more realistic one is the imperfect foresight. Now we react with the lag, and then you see you need the bigger shocks, like here more than 7%, and only then you outperform. For the smaller shocks, that makes sense. If you always rebalance for the smaller shocks on a weekly basis, like it's clear that things are different when your benchmark is the weekly return. So here you need a bigger shock so that it pays off that you go out of stocks 95%. You keep the 95%, but you sell 5% of stocks and you buy 5% of gold. Additional week, again, much stronger. And what I will tell you later, but I can mention that here already, is that like it's kind of peaking usually around the 10%, 15%, like for the stronger shocks, which suggests that it works quite well for larger shocks. Which is then more, well, not surprisingly, I mean, people react to larger shocks and they don't react so clearly when the shock is small, -1%, -2%, -3%. Like an additional 5 weeks is then, like we get closer then to the monthly stuff and it's still outperforming, right? Clearly outperforming. 10 weeks as well. That would be essentially essentially like an additional 2 months. Good. Then different investment periods, because we really look at all kinds of things. So, for example, we say you don't start to invest in 1971, but you may also start to invest in 1975 or 1980. So again, much more realistic. And then we assume here as one of the many variations that you hold it for 60 weeks. All right. What happens then? Then you still outperform. Okay, because then we average all these rolling windows and the outperformance is there. Of course, the numbers are smaller. And we do that for all kinds of rolling windows, rolling weeks, 60, 120, 240, to get a really robust picture. And this picture is robust in the sense that it works. Now the daily data rebalancing. So here, I start with the imperfect foresight, so you don't, like the realistic case, you cannot predict the future, 5%. And here, that dip there at the beginning, fine, but in general, it's underperforming, right? And that could be the case because 1%, like the 1 day rebalancing is just too short, right? So if we hold an additional day, you can see that, like things change very much, right? So you have underperformance for these thresholds. If you hold for an extra day, then things are much better, outperformance, right? And if you hold for an extra 5 days, 10, 15, you still have this clear outperformance at around a threshold of 10%. So if the shocks are -10% or larger, stock markets fall by 10% or more, then you have then it makes a lot of sense to sell some of the stocks, make things worse, of course, and buy into gold, right? You're still like then better than this buy and hold portfolio, right? The 4% that I showed you earlier. And now things get very, very different, unfortunately, which is, and we have, of course, an explanation for it. When we restrict the sample, we say like, we don't start at 1971, but we start from 2000. So we focus on the last 20 years and we do the same thing again. And then it's generally underperforming all the time, right? And why is that? So the returns, the gold returns are smaller in that period from 2000 onwards when you compare that with from 71 to 2000. And so the gold returns are not large enough to compensate for these losses. And so what worked very well over 50 years with these strong returns, also determined by that 71 to 2000 period, those 30 years, it doesn't really work for the shorter period, right? Here weekly. So here, when you look at the outperformance, the numbers are always negative. So it does not work, unfortunately, right? So here, the general message is, surprisingly, for 50 years, over 50 years, that would have worked, right? You you outperform when you see a shock and then you put a little bit of, you sell your stocks and you put 5% into gold. That outperforms, but not when you use the last 20 years, because you're just too late, right? Unfortunately, and you're too late. So remember that graph, that time matters, or the point is that you don't have time, or you're too late, and the gold returns are not strong enough, not large enough. Good, and then it was suggested that I should also look at the difference between physical gold and the futures prices, and I've done that. So the question bullion versus futures. So this is essentially when we look at these, like here 20 years, bullion price, futures price, hard to see the difference, but then in the lower panel you have the difference, bullion minus futures price, and you see that there are periods where there's quite a divergence. Right? Now here, the global financial crisis, when we look at this, the difference here, bullion minus futures. When you look at that graph, the solid line is the physical, like bullion, and it seems to be always above the futures price. So here in the it seems that global financial crisis, it seems that the physical, there's some like small, like it's not over, well, it's a clear evidence here, but we could do more, of course. So, but that physical is better than the futures price, which makes sense because in 2008, the crisis, as we all remember, there was fear that the financial system breaks down. And of course, with that fear, you're like, it's not surprising that the bullion price is above the futures price and that you do better when you hold physical. And then COVID, when you look at COVID here, you see it's close aligned, but then there are periods where it seems here kind of the opposite, that the futures price is above the physical price. And there could also be, like the explanation there could be that, as we know, I mean, COVID had a big impact on supply chains, on logistics. And so that there, in very stark contrast to the global financial crisis, the whole thing reversed, and the futures was working better than the physical. I hope that is kind of what you were looking for, Harish and others. So if I use futures then to do that analysis that we've done, like here, go in and go out 5%, you get the same thing, which is not surprising because they are very similar. So for that analysis, for that active or tactical allocation, the differences are very, very small. Yeah, because it's I guess not surprising. As you've seen in the graph, the differences weren't that big. So, summary and concluding remarks, the tactical allocation with imperfect foresight outperforms benchmarks for monthly data and rebalancing frequency, and the same for weekly data and daily data with additional days only, however, because the 1 day is too short. But then when we look from 2000 onwards, the tactical doesn't work so well because the gold returns are too small, and because investors always react with a delay. That's not a strong assumption, I think very realistic, that you cannot beat the strategic allocation. Of course, there's still like strong reason to hold gold, but that in and out, this active investing doesn't work so well. And we get the strongest performance for largest shocks, so larger than, so if the stock market falls by more than 10%, and that holds across all frequencies, the outperformance is the strongest for the full sample, but also in general, even though it doesn't work so well from the year 2000 onwards. And the findings mean that gold is indeed a safe haven and not only a hedge, because that it works when you allocate it, and because these strong reactions at large shocks mean that investors actually buy it, of course. Yeah, and if it was just a hedge, then the strong performance would not be at larger shocks, right? But yeah. So we've also done some simulations to get more ideas about, or to get more clarification on what is needed for the perfect safe haven asset. And when we do that, just a quick outlook here. I mean, we have, for example, simulated, like gold is the second number here. The message here is essentially like a safe haven, even if the safe haven is just zero, so the price is just stable, doesn't do anything. That would be enough to really boost the performance of a portfolio when you do this, right? So you don't actually have to have the price to go up to so that it works. But that's just showing you that we did much more to get a better idea of what picture what is needed for a safe haven and a hedge to perfectly work. All right, thank you. I hope I can at some stage come back to New Delhi. I like this place. I attended before COVID, I think, but just when COVID hit, I was there in 2020. Maybe next year. Anyway, thank you.
Look forward to that, Dirk. Thank you for a nice presentation, Dirk. Arvind here, Arvind Sahai. So, couple of questions for clarification. Your key thought over here is that tactical allocation is not strong enough, using the same approach that was used between 71 and 2000. So the same monthly, weekly data with additional days were used in 2000 to 2020, and on that comparison, the last 20 years tactical allocation is not strong enough. But when the shocks are higher, greater than 10%, then it still works. Would that be a correct assessment?
No, it doesn't. Unfortunately, I mean, there's still this strong effect when the shocks are large, but we generally there's for this latter sample, there's no the tactic is too weak, right? Not if you had the perfect foresight, right? But if you, because you always the
yes, I hear that, Dirk. But my question was that, I mean, one makes a like for like comparison, right? So between 71 and 2000 and 2000 and 2020, you have made the same comparison with a similar tactical approach.
Yes. Yeah.
Yeah. Okay.
Yeah.
Thanks.
So on one of the slides, you mentioned how the bullion futures is actually performing better than the asset itself when in the global financial crisis, but this is not the case in the COVID crisis. We had a similar discussion yesterday as well. Would you like to comment on why this is the case? What is it that is different about the COVID crisis that changes?
Yeah, I mean, my idea and my explanation is that the COVID crisis was there was no fear that the financial system would break down. That fear was what they called financial Armageddon in 2008. There was a fear that the financial system would totally break down, right? And so then it makes sense that any physical asset is preferred by investors, and that's what I think we see when we look at the 2008 comparison between bullion and futures, right? So in contrast, COVID, and I know this, we're like in Perth, you know, there are a lot of, in Western Australia, a lot of gold mining companies, right? I mean, then they couldn't produce anymore. And we also have reports that the gold couldn't be shipped from Europe to the US or the other way around, right? So there were disruptions in the physical market. And that could explain why the futures is doing a little bit better here.
Okay.
That's my explanation, right? But
that
maybe you can
sense.
also then tell me what was discussed yesterday, whether that's consistent with that view.
So in yesterday's discussion, I think there was one aspect that I think something similar, that is the financial market is, I mean, that's not the core of the COVID crisis. It started in the real world. And unlike all of the other crises that have been analyzed prior to this, which all started in the financial world.
Yeah. That makes sense and right, consistent. Yeah? Okay.
just
Any
ask
more questions?
one question? Yeah. Professor Dirk, this is Somasundaram from World Gold Council. Just wanted to check if it's very, very interesting what you presented now in terms of the strategic and tactical allocation subsequent to 2000. I was wondering, is it possible for us to have one more interaction separately sometime? I will reach out to you, I'll take your coordinates, and
Sure.
be
Of course.
absolutely, I mean, it's a fascinating study. We would just like to understand a little more and probably even stretch it for our purposes here, because we continue to speak about strategic allocation to gold. So I would like to just delve a little deeper, but it's better done independent of this. We can't do it in 5-10 minutes. Is that okay with you?
Yeah, absolutely. I'm very, very happy if you contact me and have a lot of time to meet with you.
Thank you.
Appreciate it.